Well, good afternoon, everyone. I'd like to start by introducing our panelists for today. Immediately to my left, John McQueen, who's the president of Wells Fargo Equipment Finance. We have Jim McGrane, who is the president and CEO of EverBank Commercial Finance. Debbie Moneson, who is the CEO and president and CEO, Boston Equity and Financial. We have Bill Verhelyi, who is the CEO of First American, and we have Charles Wendell from Financial Institutions Consulting. Financial Institutions Consulting was the entity that performed a lot of the work in this year's State of the Equipment Finance Industry report. The foundation, as you've heard from our president and our chairman, spends a lot of its effort, most of its effort, raising the money and then deploying the money for research that is of value to both the participants in the industry and those outside the industry who observe in. So the constituency of the foundation is rather broad. A couple of the foundation key reports that are done annually include the State of the Equipment Finance Industry, which is the report we're going to discuss today, the Industry Future Council report, and these are examples of where the value of independent research about our industry is what distinguishes and differentiates the foundation from the association. A lot of people have some difficulty understanding that they really are two different organizations. They're related, obviously, but the purpose of the association is advocacy and support and helping to promote the interests of the industry, while the purposes of the foundation are to provide independent and future-focused research about the industry. So that's the subtle distinction. The foundation relies on contributions from corporations and individuals to conduct its business and to support the research projects. So our plan for today is we really have two purposes. One is to review, in summary, some of the findings from this year's State of the Equipment Finance Industry report, and to share those with you, and then secondly, to use those as a springboard to get some insight from the individuals gathered here who represent different segments of the industry and represent some pretty broad experience in the industry, whether or not from their current platform. So we're going to begin with Charles running through a brief summary of some of the key findings from this year's State of the Equipment Finance Industry report. Charles?
Thank you. Good afternoon. There were three components to the report this year. One is, of course, the survey that most all of you participated in that details 2009 results. But as you know, we're now in October of 2010, and we spent particular attention this year looking at the monthly numbers, the monthly updates from the 25 lessors who participate in that. The third part of the analytical puzzle was interviews, conducting interviews with about 20 plus senior executives of bank-owned companies, independent companies, and captive companies. And we conducted those interviews basically in August and September. And the purpose of those interviews was to get a sense of your community in terms of how you were viewing the environment, whether things were changing, how things had changed, and try to give you as current a picture of the state of the industry as possible. The fact is that when you look at 2008 and 2009, you'd want to have a different picture of the state of the industry. 2009 was a bad year, to use consulting phrase. Just look at the numbers. Volume 30% down. Delinquencies up 40%. Non-accruals up 100%. Charge-offs up 129%. And employment down by 5%, 5 or 6%. That is not a pretty picture. But again, that's a picture based upon 2009 and the end of 2009. Let's take a look at where we stand now, looking at 09 August to 10 of August of 2010, which is the most recent monthly data that we have. And you can see a change has occurred. Certainly in the interviews we conducted, virtually everyone we spoke with thought that a bottom had been reached and that the worst was over. And these numbers certainly would indicate that. New business volume is up by almost 15% year to year. Older receivables beyond 30 days are down. Charge-offs are down significantly. Those three numbers are all trends you would want to see. And then, as with the larger economy, employment continues to be down as companies either manage more ferociously, as they hold off buying, as they become more reticent about their concerns, or continue to be reticent about the future. I mentioned that we conducted interviews, and these were very good interviews, an hour or so in length each one, in which we asked a lot of questions about how they were viewing the industry, how they were viewing their own companies, how they viewed the next 12 to 24 months. And let me just run through what some of the themes were. While, again, virtually everyone said that the bottom had been reached and they did not expect a double dip, nonetheless, continued uncertainty was one major theme. There's no one who is saying the world is getting better and we're going straight up. Instead, they read the same papers you read and we read, and 1 month the numbers look pretty good, the next month the numbers aren't so good. For example, the most recent confidence numbers that the LFA generated and provided, those were positive, but that's not a trend. And people are desperately hoping for a trend, and no apparent trend has surfaced yet. So continued uncertainty. Virtually everyone says that near term, with one exception I'll come back to in a minute, near term we expect slow growth. Longer term, the industry is valuable. The industry is necessary. The industry has a real purpose. And in general, there's quite strong confidence for the industry going out 2 years, 3 years, 4 years. Third point, stronger role for risk management. Now, by that I don't mean that risk management has not been important in the last 12 to 24 months. It certainly has been. But in the last year, people even put a greater focus on risk management. In some cases, rescoring their loans, looking at their portfolios in greater depth, getting tougher on collections or changing their collections approach. So even, in some cases, even those that had a focus on risk management all along, as most of you had, they said, well, maybe we can do a little bit more here, a little bit more there. And the pendulum certainly swung from a sales focus of a number of years ago, much more over to a risk management focus recently. Next point, sharper focus on segmentation and selectivity. I certainly asked the question about innovation and where innovation was happening in the industry. And there was very little innovation in terms of products. But in a sense, there was an innovation. People mentioned their own emphasis on discipline, their own emphasis on being more selective, their own emphasis on coming back to a core value proposition. To them, that connoted, and I think it does connote, a focus on an approach towards innovation, and certainly an approach that emphasizes segmentation, that emphasizes knowing who your customer is and how you can differentiate yourself. So there's been a redoubling of the effort on that score. Internal desire for growth differs significantly. And by that I meant that in a number of cases, I talked to banks, in particular banks, that were in a strong capital position and whose ownership was looking at the equipment finance group to generate asset growth, which they thought their traditional commercial bank could not generate. So in a sense, the equipment finance group is being meant to make up for a lack of asset generation capabilities in other parts of the bank. Next part, some retrenchment in small ticket leasing. And this was a little bit of a surprise. There's so much talk about small ticket. A number of the, again, particularly bank-owned companies I talked with, and I've subsequently had this confirmed in other conversations with clients, have pulled back a bit from small ticket. Why? Because they had bad history, bad experience using generic models. Those banks or companies that depended upon generic models in scoring their small business loans had a much rougher time than those that had spent the money and the time to develop proprietary models. So not surprisingly, those banks that were relying upon generic models are pulling back from that. That means they're touching the loans more. They need to touch the loans more. That means the cost of origination is going up. And so for those reasons and others, a number of banks have, I'm not sure they even admit that they are doing it, but they have in effect de-emphasized small ticket financing. The last part is something you all know, growing concerns over accounting and regulatory impact. And during the interviews I did, I heard everything from it's going to change the nature of the industry to it doesn't really matter to us. What people are doing now is they're spending a lot of time, as is the association, spending a lot of time evaluating it, trying to understand it, and looking for some clarity there and for some certainty there, as well as with the larger economy. And what they're looking toward is probably a mid-year 2011 timeframe, at which point these rules and regulations should become clearer. So everyone hopes. Last slide, and then I'll move over to the panelists. What I did find is that there were different approaches based upon the kind of organization you are. Obviously, the banks are leveraging their lower cost of funds. They are in a superior position from that perspective. They're also, and I have said this, or I've talked about the need for cross-sell for 10 years, and though this slide has it in there as well, but banks are getting more disciplined about exploiting, in the best sense of the word, exploiting their relationships. In some cases, banks are limiting their marketing focus to their branch area or their catchment area, as opposed to having a national approach. They're trying to take advantage of the brand they have with their customers and sell more to the current customer, really building wallet share, which is one of the topics from this morning. And again, in some cases, they are limiting their small business exposure for good economic reasons. Independence, both by tradition, as well as in some cases by being pushed into it, they are emphasizing segmentation. They're emphasizing their selectivity. I wanted to make a point this time of interviewing a number of independents, because obviously the numbers from last year for the independents wasn't very good, and they don't have the benefit of certainly don't have the benefit of the cost advantage of banks. But I found a number of independents, several of whom are on the panel, that are very disciplined in their approach, that know what they're about, that really have emphasized, as this slide says, customer service and customer segmentation. And independents like that can and will survive going forward, and may in fact continue to play a bigger role going forward as some banks enter the market and other banks remove themselves from the market. One word about captives. They play the game differently than banks and independents, in my view. And that quote, "We don't quit on a customer unless they quit," was very indicative of what I heard from a number of captives, including one or two I spoke with today at this meeting. They're going to, because of their purpose, they're going to work with a customer and continue to try to get that customer through a dark patch. And that certainly paid off for them this year, when you look at the numbers in the report, where they took additional share, where they certainly have positioned themselves very well with their customer base. And with that, I'll pass over to Joe.
All right, thanks, Charles.